What's going on, guys? Welcome back to the channel. Welcome back to another video. If you guys are hanging out with me for the first time, do your boy a favor, drop a quick like for the video, also subscribe to the channel. Well, guys, are we headed for a rematch with 2008? Are we going to see another 2008 in 2023 going into 2024? Are we going to see this massive recession, this housing market crash? You guys have followed my channel for a while. You guys know that the Federal Reserve recently announced that interest rates will be held in place as of the June 2023 meeting. So what this means is that the Fed has realized, hey, we've made our mark. We've seen multiple banks collapse. They don't want to lose all confidence among the American people in terms of the financial markets and within the banking system. Let's hold off a little bit. CPI inflation's coming down a little bit. Prices are still very high. Housing market prices are still well above pre-pandemic levels, and most real estate investors and homeowners alike are still up on their investments in their real estate. Assuming you purchase your home, I would pretty much say that if you bought a home in 2021 and earlier, 99% of people have seen their investment appreciate dramatically. And I'm willing to bet that no one really is taking any kind of substantial losses whatsoever in the real estate market. Now, renters have continuously been seeing their expenses increase, and even homeowners. Cost of living has been increasing dramatically between property taxes going up, HOA fees continuously increasing thanks to rising insurance rates, also thanks to the higher appreciation values of the properties. It costs more now to rebuild these properties because the materials are higher, yada, yada, yada. All right, now, are we going to see a crash? There is a new program that has just been announced. So this new program is supposed to be helping homeowners and borrowers keep their homes after, get this, after missing up to 12 months of payments. Now, we've been talking about foreclosures taking place here and there, and there has certainly been an uptick in foreclosures. But you guys have to remember, you know, like during the pandemic, there was a lot of government programs put in place to prevent the housing market from crashing during that time, to prevent an economic collapse during the time where the entire economy was shut down. So now we're in this weird state of the economy and this transition where many people are being, you know, told to come back to work. Many people are losing their jobs. You know, layoffs are taking place, whatnot. Lots of different companies have announced layoffs. But right now, you know, you got the student loan payments that are about to kick back in. You also have a lot of these pre and post, or I should say post-pandemic programs that are ending. So here's the thing. When these programs end, these were things that were helping people to be able to afford to stay in their places, even though they weren't necessarily able to work. So what happens when all of this mortgage assistance programs end, right? You have renters moratorium, allowing renters to basically stay in a place and not have to pay rent for months, many months and years on end. But the federal programs supporting people being able to stay in their homes and not have to make mortgage payments, those were ending. But check this out. Homeowners struggling with their mortgages will now get a powerful assist starting July 1st of 2023. So basically, this is a revamped policy from Fannie Mae and Freddie Mac, which is going to allow some people who have missed their mortgage payments to qualify, get this, to qualify for deferment and to avoid foreclosure. Now, make sure you guys share this video with your friends and family, because a lot of people may not be aware of this particular program. So let's go ahead and, you know, shine a little bit of light on this program. That way, if anybody happens to need some assistance on this, you know, this is available to them. Now, what does this mean from an investment standpoint? What does this mean for you know, homeowners standpoint? What does this mean for renters? What does this mean for buyers and sellers in the housing market? Well, number one, When we look back at 2008, we have to ask ourselves, okay, what happened leading up to that point? Well, clearly there was an inflationary problem. There was a housing inventory problem. There was too much inventory. There were not enough qualified buyers entering the market to buy these properties up, and ultimately the prices began to become softer. There was softening in the market in terms of the price appreciation of these properties. Many people were buying these homes thinking, oh, well, real estate always goes up. This is the easiest way to make money. You can invest in real estate and, you don't even have to prove your income. You can just, state your income and not verify your income, not show any kind of assets or any type of bank statements. Just sign here. I'm alive. Here's my social security number. I promise to pay you back. That's pretty much how it went. You had no doc loans and whatnot, but ultimately there was a very low criteria for getting approved for mortgages back in 2008. Now, when the Federal Reserve began manipulating interest rates back then, and also as more and more people started getting behind on their mortgage payments as their interest-only mortgages started going up, more and more people were unable to continue to pay their mortgage payments. If you had a interest-only payment or an adjustable rate mortgage, if your mortgage was subject to the rate of the LIBOR or whatever the Federal Reserve's interest rates were, if you had a variable rate mortgage loan, then your payment went up as interest rates went up. And this began the shift to collapse the housing market back in 2008. So now the question is are we going to see this again in 2023? Well, it looks like the Fed is trying to get ahead of this thing. So, this revamped policy from Fannie Mae and Freddie Mac, they're going to allow some people who have missed their mortgage payments to qualify for deferment and to avoid foreclosure. They see the writing on the wall, folks. They see the writing on the wall. Now, here's the thing. The Fed also did not raise interest rates. So let's put the two together. This new program's coming out trying to save homeowners because they're seeing something happen and they're trying to get ahead of this thing. Remember, they're trying to kick the can down the road. So, number one, they didn't raise interest rates again, although many argue that they should have and could have. But also, this program starts July 1st of 2023. Also, they're going to be expanding their existing deferment rules. Fannie Mae and Freddie Mac will be enabling eligible borrowers to defer payment for the next 6 months, or I should say for the next 2 to 6 months. Flies are attacking me now. I was good all day. Anyway, so, the total amount of the missed payments will be tacked on to the end of the mortgage term. Very similar to what we saw during, the post-pandemic deals and offers and financial assistance that was being offered to millions of Americans. We're starting to see this again. So, is this a housing market crisis that they're trying to keep under wraps? Now, what does this mean for investors? Well, if the government's going to step in and prevent people from getting foreclosed on, well, the foreclosures are what drove the housing market down in 2008. Why? Well, a foreclosure in and of itself doesn't cause the market to crash. You got to look at it like this, right? It's always about supply and demand. During, let's just say, in 2021, when houses were flying off the shelves and people were fighting just trying to get in the door, and you were getting like multiple offers well above asking price, if you had a foreclosure hit the market, it wouldn't even hurt the market at all. In fact, you could have tons of foreclosures hit the market and the market would have still been fine. Why? Because the demand was so great. You'd have to have a ridiculous wave of foreclosures all of a sudden to have that happen. But at the time, the government was basically sending checks out to everybody. They had all sorts of basically stay in your home and we got you types of assistance programs going on. So there was no chance that there was going to be a huge wave of foreclosures in 2021 happening. But now, if you guys see, there's a lot of quantitative tightening taking place. Jerome Powell has raised interest rates for the last 18 months in a row, except for June. of 2023. So there's a complete different direction that we're headed in terms of our economy. And at least from a foreclosure perspective, I seriously doubt that we're going to see a major correction in the housing market from here. In fact, as quiet as it's kept, some people are saying, if Fed Chair Jerome Powell went ahead and paused interest rates for June, maybe they don't want to admit it verbally out loud, but maybe that this is like the start of the highly anticipated Federal Reserve pivot, where basically, okay, they've been raising interest rates, raising them. Okay, now you guys don't raise the interest rates. The Federal Reserve didn't raise interest rates for June. Does that mean that in a couple more months, the Fed does another pause? In a couple more months, does the Fed lower or reduce interest rates? It remains to be seen. But clearly, they're reevaluating their plans. And we're seeing, if you follow Forex currencies, you'll see that the US dollar has been increasing drastically. Like the strength of the US dollar. Now, don't get me wrong. Here in the United States, if you're trying to buy stuff, your dollar doesn't go nearly as far as it used to. However, in comparison to other countries, if you were to now take your dollar over to Argentina, for example, you will get a lot more for your money than you would have gotten, say, a year ago, or even 6 months ago, a year and a half ago. Like, there's a drastic increase in how much value your money, your USD, is worth today compared to most countries in the United States, or excuse me, compared to most countries in the world. So, but this is actually creating a bit of a, shall we say, some of these countries are getting a little ticked off. Why? Because these countries do business with us. And the way it works is, if our currency becomes more powerful than theirs, or more valuable than theirs, maybe valuable is more accurate in describing this situation, then it makes their currency ultimately less valuable in comparison to ours. So why does this matter, right? I mean, it's not like, hey, mine's bigger than yours kind of thing. But the thing is if our USD value is more valuable than their currency, then what this means is that it takes more of their currency to buy our stuff. So as these countries are doing trade and business with the United States, if their currency is basically devalued simply because we've pumped ours up, it makes everything more expensive for them that they're trying to buy from us. Now, of course, the United States doesn't, we're not a high producing country anymore, unfortunately. But, if these countries are using US dollars to pay for other things, and, maybe one country is accepting their currency in lieu of US dollars. So, for example, oil's often purchased in USD. Now, of course, this is changing a lot, but oil's usually purchased in USD. It's certainly valued in USD. Well, if you are paying for oil as another country, your currency being worth less than the US dollar is now making this purchase far more expensive for you. So, I'll give you a great example. A buddy of mine went to Argentina just recently, and he was telling me that a month ago, 2 months ago, it was like 400 pesos to every $1 US. Well, as of today, it is now 495 pesos to every $1 US. So what this means is that it is way more expensive in Argentina to buy anything from the United States. But on the flip side to it, let's just say you were taking your US dollars to Argentina, you're a freaking king now. Your value, your currency has gone up by a good 20%, maybe 25% in a matter of months. So this is happening across the board. Now, in addition to this Fannie Mae, Freddie Mae policy payment deferment deal that they got going on here starting July 1st, a borrower who gets a deferment has to wait at least 12 months to apply for another one. So, for example, if you miss your mortgage loan payment in January and you happen to get a deferment, then you can't get another deferment until at least the following January. Now, this requirement is waived, however, if your previous deferments were due to, a C-19 natural disaster. So they do have loopholes available. Now, in July, the deferment program will be a voluntary option for mortgage servicers, but it will more than likely become a mandatory option beginning October 1st of 2023. Now, I can't imagine why a mortgage servicer would not want to take advantage of this program unless, some of these unscrupulous mortgage servicers want to foreclose on people's houses. Yeah. So let's just talk about a little bit, what is a mortgage deferment? So a mortgage deferment, also known as a deferral, basically it allows borrowers to move missed mortgage payments to the end of the loan. So let's just say you had a mortgage payment maybe you got a mortgage from Bank of America or JP Morgan Chase or Wells Fargo, and you missed your mortgage payments. If you have a 30-year fixed rate mortgage with Bank of America, then your missed payments, let's just say you are 5 years into the program. So you're 5 years into your loan. So what's that? 5 times 12 is 60. So out of your total 360 payments, you're at payment 3. You're at payment 60. So that means you have 300 more payments to go. But if you started getting behind on your mortgage, then that would mean that, okay, let's just say you start missing your payments. If you miss 10 payments, you still have the 300 payments that you still have to pay back the 300 payments to pay off the loan. But what they're going to do is, with this program, they're going to take your missed payments. Let's say you missed 10 payments. They're going to add those to the back of the loan. And I think instead of being at payment 300, you'll probably be at payment 310 or something like that, right? But the problem with this is, and maybe they'll refine the program over time, this is going to drastically increase how long it's going to take you to pay your home off. So if you ever wanted to become debt free and pay that home off, taking advantage of this mortgage deferment program may actually be a decent idea in the short term, but it could totally screw people in the long term and potentially take your 30-year mortgage and end up stretching that sucker out to like 40 years. I don't know how many people want to stay with a mortgage for 40 years. 30 years is already long enough. But I guess if you're at risk of losing the home due to foreclosure, this may actually be a valid option. So drop me some comments, guys. Let me know what you guys think. Now from an investment standpoint, if we don't see foreclosures, and if interest rates stop increasing like the Fed has done, I mean, at least for this quarter, for this recent Fed meeting that they had, if these interest rates do not continue to increase, we may have actually seen the floor of the housing market crash, because they're not going to let people have their homes foreclosed in widespread, in masses. So we already know that's not going to happen, thanks to the Freddie Mac deal that they got going on, right? So the only other two major things that would have an impact on housing prices, I guess 3 things. Number one, a tremendous amount of inventory hitting the market. Now, if you happen to live in Florida, you already know that there's a lot of construction that's been on pause because of this whole immigration law that's come out, and many construction workers are just not working, and this is dramatically slowing down the additional new construction homes hitting the market, because a lot of people are just not building homes in Florida right now, or a lot of construction workers are not building homes in Florida right now. So, maybe some parts of Florida are worse than others, because I did receive, had a couple people tell me, oh, well, we're still building in my area. Okay, maybe Orlando's slow for construction, but what about Miami? What about Fort Myers? What about Sarasota? What about Jacksonville and Tallahassee? Daytona Beach, who knows? Naples. So obviously it's going to vary from place to place. And as I always say, real estate is always local. So me personally, I'm starting to really think that we may be already at the bottom of this housing market. And this little 10% pullback may be all of the discount that you're going to get. So now the question is this: where do interest rates go from here? Do interest rates for mortgages go up, or do they go down? At this point, it's really hard to tell, but it really does look like a bottom may be forming for the housing market at this time. So if additional inventory doesn't hit the market, then I would imagine, then you know, if there's any kind of delay that slows down the process of bringing new inventory to the market, this is further helping stabilize the housing market prices from going down, and it actually gives the housing market the momentum to almost start going back upward, because again, it's supply and demand. The other thing is if interest rates don't continue to climb and they stabilize, possibly go down, then that's going to encourage people to want to buy houses again. And what's another thing? If the labor market stabilizes and we don't see tremendous amounts more layoffs and the unemployment rate starts to kind of stabilize, maybe even begin to improve, we could very well be at the bottom of the housing market, and we may actually look back now and say to ourselves, wow, I should have bought now. Because if the Fed gets to a point where, you know, hey, if we go into a recession at the end of 2023, going into 2024, the Fed may panic and say, hey, we have to start cutting interest rates. We got to keep kicking this can down the road, because we don't want to lose our economy. We don't want to destroy the economy and send ourselves into a recession. So rather than risking a recession in the United States or depression, maybe the Federal Reserve says, hey, we're going to hold off on interest rates here. We're not going to drastically reduce them, but maybe we did a little too much. Let's pull some back. If they do that, mortgage rates begin to come down. Mortgage payments begin to come down. Buyers will be able to be approved for higher mortgages because the payments associated with them would be lower, thus reducing their debt to income ratios. So this would improve the buyer's ability and would drastically, or would begin to increase mortgage application demand and kind of start sending these housing prices back up again. These are all hypothetical scenarios, but these are things that I'm looking at if I'm an investor, or even if I'm a home buyer. You know, whether you're in Florida or Georgia or California or Nevada, Las Vegas, Texas, South Carolina, it doesn't matter. These are the same market indicators that I'm going to be looking at to determine, is now a good time to buy, is now a good time to invest. But drop me some comments, guys. Let me know what you guys think. If you made it this far in this video, do your boy a favor, drop a quick like for the video. I appreciate the conversation and hanging out with you guys as always. Also subscribe to the channel. You guys be safe, and I'm gonna see you on the next one.